It's equivalent to, for instance, if you have a network that relies on $100, can you credibly say that it could secure $20,000 worth of transaction volume or assets, tokenized assets? Probably not. Well, that's about the scale that we're looking at. Right? There are $200 trillion of liquid traditional real world assets that are waiting to be tokenized. There are probably even more, or there are definitely more of more illiquid assets that needs to be tokenized. So you're looking at, multiple hundreds of trillions of dollars. Proof of stake alone network with permissionless validator set. I think that's going to be a pretty hard battle to argue that it is secure enough for those type of use cases.
Today, we're glad to have Gordon Liao as our guest. So Gordon is the chief economist at Circle, but he's got a really interesting background. I've been lucky enough to know him for, I think, more than 10 years maybe at this point, although I don't want to say it that way because it makes me feel old. It probably makes him feel old. Uh, it occurs to me that people say this thing about, the military, they do whatever more than anybody by whatever some early time of the day. So for Gordon, I'd say he's done more by 30 than most people do their entire lives. So just to give a little bit of a background on that. So first of all, of course, he went to Harvard. And then when he graduated, the first job he got was actually working on the buy side as a trader. And I know a lot of people, when they start working as a trader, including myself, who was on the sell side initially after college, you don't do a lot of trading. You do a lot of, let's call it grunt work for the moment. But Gordon actually started trading his own book very quickly. And actually, that's when I first met him. So I met him while I was on the quant side, where he was working as a trader. And of course, he was a superstar over there. But I guess he has this thing where he's got to conquer a new hill every time he conquers one. And so, like, I don't know, after like 2 years, or he's already trading his own book, and he's clearly very important to the business. He goes, "Hey guys, maybe I should go do a PhD." You know, that I actually was at his going away party. I remember. And so, I suppose it was a bittersweet thing because obviously he was doing a great job for them, but at the same time, he was leaving. And so, of course, he went and he did his PhD from Harvard. I think it was actually the business economics thing. So it's kind of like Harvard doesn't have a finance PhD, but they do have a PhD, which is joint from the business school and the economics department, which is where the finance faculty is typically most involved. So kind of getting a very solid foundation in economics more generally, but also a lot of finance. And so he graduated from Harvard, and I believe the next stop was the Fed board, right? He was an economist at the Fed board, and he very
In
quickly
between,
put.
I spent out a SMA fund with some of my prior colleagues, but that's a short interlude.
Yes. So as I said, there's so much on the CV I couldn't possibly remember it, even though I know Gordon personally. But so at any rate, so eventually he was at the Fed, and he put together a really impressive research portfolio, tenurable at most places, I'm sure in the U.S. And it didn't take him very long to do that. But of course, it's like he needs to conquer another mountain. So he eventually, after I think just maybe a few years, after putting together a really stellar academic research portfolio, he moved on to actually a place that Brad is very familiar with, because I believe Gordon's next stop was Uniswap Labs. I think he was the first ever director of research over there. Like, I'm not even sure if they had a research division. They're like, hey, if we're going to hire this guy, we better have a research division because he's the guy on this stuff, right?
That's right. For the
Um,
research division.
and in fact, I think, like, when he left, the position of director of research or whatever just sort of vanished, because I was like, well, you can't follow Gordon, so you may as well just like retire the position. And
Wait, fun story to add there is that he actually interviewed me for my internship at Uniswap. So that's how I met Gordon. Yeah.
So yeah, in fact, I'll add to that in a certain way, which is that, so I think I mentioned I first met Gordon back when he was working as a trader, but then he and I didn't talk that much for a while in the middle. Nothing personal, but there wasn't a reason to it and such. And then we reconnected back when he was working at Uniswap as director of research, and I remember I invited him to give a webinar. And I was like, hey, yeah, why don't you talk about decentralized exchanges? And he says, hey, what if I talk about decentralized exchanges and stablecoins? And I was like, yeah, okay, sure. I mean, the stable pools are really like at the top of at the top of the trading volume thing anyway. I'd love to have you talk about that stuff. And then, of course, maybe like a month before he's about to do the webinar, he announces that he's joining Circle, which incidentally he wasn't totally leaving Uniswap. Like he was leaving the director of research position, but I believe Gordon, you're still an advisor to Uniswap, right?
I think I advise less these days than before.
Right. So you took a position as an advisor, which perhaps is still going, but maybe less day to day. And then chief economist at Circle, and that's got to be a really exciting place to be for reasons we will be discussing, throughout the podcast today. But so Gordon, is there anything you'd like to add? I tried to do it from memory. I don't have your CV in front of me, so I might have missed, some other things that you did. Like I don't know, you said some other startup you created, and
Thanks for the very kind introduction. It's great to see you, and thanks for the invitation. It's always good to be back with friends, and especially someone I've known for, I guess, bulk of my career since my first job. So great to see you, Fahad, and Brad, good to see you as well. Yeah, I think it's been really interesting to have had the luck I had to experience so much across different aspects of finance, whether it is trading fixed income at Harvard Management or working on the most decentralized thing ever at Uniswap or going the most centralized route at the U.S. Central Bank. Certainly learned a lot and looking forward to our conversation.
yeah, so why don't we dive right in? And I kind of prefer to start at like the 30,000 foot level. So stable coins are all the rage, as we'll discuss. But I kind of want to take a step back to before we were in the space where everybody was kind of very excited about stable coins and kind of take us back even like over a year ago when, people like us probably on this conversation were very excited about stablecoins, but it was a little bit harder to kind of see what the trajectory was going to be because there wasn't the same political environment. But so in that position, what exactly did you envision, Gordon? When you moved to maybe Circle, what did you envision was going to be the long run significance of stablecoins? So like if you were when you first moved to Circle thinking 10 years forward about what the big stablecoin applications would be. What were those?
Yeah, I think it goes back even before then. So the first time I heard about stablecoin, I think it was actually around the time I was at the Federal Reserve. I was in the international finance team and looking at capital markets in across different areas. Of course, foreign exchange market is part of it. But it was also around the time that Libra, the stablecoin project that Facebook or Meta was pushing behind, surfaced. And that became really important quickly for the central banking community because the fundamental construct initially posed a certain threat to monetary sovereignty of many countries in its basket format. So that's when I for the first time got involved in stablecoin, but on the other side, and I was actually somewhat involved in the team that eventually had played some role in kind of basically Meta, as you know, eventually ditched the project after some pushback by various regulators. So at that time, I realized the importance of stablecoin and also of just tokenized money and digital money. At the time, I was at the Federal Reserve Board's technology lab, and of course, we looked into things like stablecoin, but also central bank digital currency. And even that early part of the experience made me realize that stablecoin would be a core part of the financial system many years down the road. The reason I say that is because if you look at how traditional banking is constructed and the various frictions and the various points of failures there are, it was very clear that there needs to be a solution that solves both on the technology angle, but also from a balance sheet perspective. And going forward, looking forward a couple of years, when I joined Circle, it was very clear to me that the stablecoin sector will grow in importance. I think it's still pretty early in terms of its adoption. So already we're seeing cross-border movements of value through stablecoins, usage of stablecoin across many countries. But I think if you think about in the very long term, say a couple of decades down the road, what is the value of stablecoin in terms of global finance? I think it will be very core to not just payments, but to many of the other layers of finance. If you think about traditional intermediations of credit, how stablecoins would be core to that very central part of finance. I think it will be used for not just business to business payment, which we see some today, and digital asset transactions, which we see today, but also it will be core part of international capital flow, settlements of traditional tokenized securities. Hopefully by then everything will have some tokenized version of. I think it will also play a very large and increasingly important role in the space of AI agentic payments. Right now, if you are following what's going on in the AI space, the agents are kind of just blowing up in terms of their functionalities, in terms of how they interact with the broader web and with each other. You have essentially agents providing services that people couldn't dream of a couple of years ago, and that's only going to increase in terms of complexity and in terms of the value they actually represent. So now you have a lot of model context protocols out there that are providing these API-like services for agents. But of course, on the other side, you have to have some sort of value exchange for those services. And that's where I think eventually stablecoin will play in terms of providing the payment rail for AI agents as well. So if you go into the far future, I think that's where we'll land. But in between, I think it's also about every layer of finance, whether it is payments or people taking out a loan through private credit type of markets, and invoicing, treasury management. A lot of it could have stablecoin involved in one way or another.
You guys jump too far into the future. I just want to ground it back on two things Gordon said, which I think are useful for people, for non-econ people like both of you. Is that Gordon, you mentioned that there were some sort of frictions and failure points in TradFi that stablecoins can relieve. So it'd be nice if you could elaborate on what some of those are first. And then also, you talked a lot about the uses of stablecoins in the future. But again, to help ground it, can you tell us what are the main uses that it's being used for today? Just like those two things to help ground us.
Sure. Yeah. So people always by this point, I think everyone heard this spiel about stablecoins solving the issues of frictions in finance that comes with the speed of settlement, for instance, and how much creditworthiness there is in terms of settlement. If you zoom out broadly, right, what is a stablecoin? Right, it is a form of, I would say, it's a form of money that is relatively narrow. Right? It is backed by full reserve, almost full reserve government liabilities of sorts. And it doesn't have as much credit or liquidity transformation or maturity transformation. So if you think about the biggest problems, at least from a regulatory angle, from a systemic risk angle, is the failures of very large institutions that are at the center of intermediation. In some ways, I think stablecoins solve that fundamental issue by kind of removing all the layers of complexity, the various layers of both transformations of credit, maturity, and liquidity out of the picture by providing a very clean asset for payments. Now, you could have a separate instrument for for savings and credit. But for a payment instrument that is just divorced from the complexities and the almost like the unnecessary parts that shouldn't be part of the payment equation. So this idea actually comes from very early on in the 1920s or in 30s or Chicago economists that were discussing, I think during the middle of the Great Depression, they were talking about essentially separating out payments and credit provision function on banks. And that became known as the Chicago Plan. And every time there's a crisis, people talked about it, but never actually implemented anything close to it. I actually think stablecoin is the closest reincarnation of that sort of framework. And that I do think has an important role to play in basically deleveraging a lot of leveraged institutions and deleveraging quite a bit of the unnecessary leverage that exists in the financial system.
Got it. Oh,
And then
then
in terms of current use cases,
yeah.
well, as you know, stablecoin came out of digital asset trading. Initially, is used as a settlement instrument for many of the digital assets. So that remains to be a core part of stablecoin use case. But by now, I would say probably half or more than half of the use case are actually payments related. It's probably actually large value payments cross-border, especially between South and South type of countries. This is related to a paper I wrote on, it's called Beyond Blockchain or Beyond Speculation, stablecoin as RTGS, real-time payment systems. And in that paper, I actually highlighted if you look at the amount of growth in the circulation of stablecoin, as well as the transaction volume, far surpass the amount of growth in digital asset trading. Digital asset trading, while there has gone up and down, it has largely been relatively flat over the last couple of years because they were early on. I think in 2020-ish, 2021, there was a lot of trading activities as well. Right? That hasn't grown nearly as much as stablecoin have, which have grown in multitudes, right? So if you actually look at just the sheer amount of circulation, volume growth of stablecoin, it cannot possibly be explained by the proliferation of digital asset sector by itself. A lot of it has to do with actual payment usage in many parts of the world.
So I want to kind of dig in more about on the application side, and but I think one important thing to discuss before we talk about not just current applications, but sort of applications that we anticipate in the future is the change in the regulatory environment that we alluded to earlier, right? So we've now had stablecoin legislation not just considered but passed through Congress, and so. I guess my question is, what is the significance of the Genius Act for the actual, let's say, evolution of stablecoins being used in practice?
Yeah, so that's a great question. I mean, Genius Act is a huge step forward in terms of regulation, not only for stablecoin, but for all of digital assets. If you think about it, right, for years, the industry have been, or a certain part of the industry at least, have been asking for regulation, have been asking for more of clear guidance of what is permissible, what is not permissible. The Genius Act spelled out very clearly the activities that are qualified as payment stablecoin and what it takes to be a payment stablecoin issuer, and what the reserve backings are, and what type of prudential standards needs to be there. I think that is a very large elevation in status of stablecoin as a form of money, because it sets the ground rules. It's a regulated instrument that is for the larger stablecoins directly being under the guidance of the OCC. And for the smaller ones, there's a state path to it, and in the US. And that also sets the stage for more international recognition of stablecoin as a medium of exchange as well. So prior to the Genius Act, in Europe, there was already MiCA, which addressed some part of the stablecoin issuance type of requirements. But in the US, which is still the largest place for stablecoin issuance and innovation in the digital asset space, there has been a lack of clarity until more recently. So I think it does open up the doors for a lot of enterprise level usage and adoption. We also have seen a flood of enterprises announcing that they're interested in either adopting stablecoin or perhaps innovating with their own version of stablecoin. But I think it definitely opens up the gate for using stablecoin as a payment instrument for commerce and for enterprise level type of payments.
So you're saying as a payment instrument, and so this kind of there are a few different things that I think we've talked about already that I'm trying to put together in my mind here, and I always kind of come back to this point about. So you mentioned earlier, for instance, lending protocols very early on, and in some sense, that's one place where stablecoins are really important and really useful. For instance, borrowing is one of the things you can do through a lending protocol, borrowing a stablecoin, which potentially could be something that, there's a lot of, small business loans and so on that you could argue that essentially this is the same service. But related to actually what you were alluding to at the time we were talking about the liquidation mechanism. I think one of the big pushbacks that always sort of comes back on these topics is that, well, whatever is the economic value that is currently being generated on blockchain, it's largely somehow being supported by some level of essentially speculative trading, right? So in the case of, let's say, lending protocols, you go like, well, why are these people actually paying interest on their borrowings? It's not the fact that they are a small business who is trying to finance their business because they're taking out over collateralized loan. And this goes back to that Oracle problem thing, which is the fact that, the collateral they're posting is probably some risky crypto, which means that probably they're doing leverage trades and they're not pledging their equipment or their plant or whatever in order to take out the loan. And so, what now that we have some regulatory clarity, what do you see the way forward as being in terms of getting the sort of the real world assets involved? First of all, I guess, is that even necessary? Like, if 5 years from now, there isn't any serious level of tokenization, is that a fundamental problem? Because if we're just if we think like there are massive applications in payments by itself, then maybe we don't need that. I don't know. But yeah, so could you maybe like help us understand kind of the evolution of the mainstreaming, let's say, of stable coins? And I mean more than just like the rhetoric. Like right now, if you turn on obviously any sort of mainstream news coverage, there is some level of stablecoin coverage. The phrase at least is probably relatively common, but that doesn't mean that it's being used, on a regular basis by people who are not in the crypto community. And so could you give us a little bit of a sense of the evolution of how that's supposed to happen? And specifically, is it necessary to have real world assets that are tokenized? And if it is, then particularly when they're non-digital, how does enforcement work? And how do we need even more regulation or regulatory clarity, or are we already kind of in a good place with that?
Yeah, so I definitely don't think it's necessary to have tokenization of other real world assets for payments to occur, right? So, and that's already happening. So if you go to, I think we all come from a very US centric point of view, right? But if you actually go to parts of Latin America, parts of Africa, and talk to like the largest importer exporters, you'll be surprised to find that a lot of them actually already use stablecoin for international transactions, oftentimes through their foreign exchange dealers, and oftentimes they do not necessarily even know that they're using stablecoin well for international transactions, but they're already using stablecoins in some ways and form. Now, on the retail side, I think that depends, right? That depends on whether you are more crypto native in the developed market. In the emerging market, I think there is more adoption in certain areas in which it has a certain appeal because of volatilities of perhaps local governments and local currencies. But in terms of the different steps to adoption, right? Payments is one fundamental core part of finance. It's already a very large part of finance if you think about the value that's moved around the globe and what it represents. Very adjacent to payments is, I would say, foreign exchange is actually quite close to it. Right? When you make payments, especially cross-border, foreign exchange is oftentimes needed. So there has been, I think when I spoke to you a couple of years ago, when I mentioned talking about DEX and stablecoin, the application was actually foreign exchange type of DEX, not necessarily one stablecoin against another. So it's very natural you have the FX market, which is like the largest market, $9 trillion per day of volume, to possibly adopt stablecoin and possibly adopt on-chain trading as a forum for both settlement and for exchange. And then on top of that, you get into what type of assets could you actually tokenize and what is the additional benefits of tokenizing those assets. Now, there's certainly the public liquid type of assets that currently people could already purchase in some sense. And there's also a set of less liquid, but perhaps still traded assets. So you mentioned the example of, maybe you can't get a small business loan through stablecoin today. Well, you have more and more of these tokenization platforms, right? So for instance, like Maple is a great example of a protocol that's doing more of the lending against perhaps off-chain credit or off-chain sense of credit. So you do have the Oracle problem that one needs to solve, and there are many people looking at this problem as well. But I do think it could still be an instrument for solving those problems. And as you bring on more of the traditional securitization type of assets, for instance, today most of the mortgages are packaged up as MBS and sold off, right? So banks today no longer fill that role of, based on soft information, do lending against their deposits. Rather, there's taking deposits and maybe investing in some MBS, some treasuries, and on the other side, originating essentially loans, but then also selling off for repackaging, right? So you could also see, I think there are already some projects that are doing this, tokenizing MBS type of securities, and perhaps those type of tokenized securities would transact on chain as if there are more digital native type of assets. Then you could very well see the possibility of perhaps having a fully on-chain type of lending against tokenized assets, maybe as your own tokenized set of assets. I think this space is evolving so quickly that it's oftentimes easy to miss the bigger picture of what it actually represents in terms of the changes in the fundamental balance sheet construct of financial intermediaries and finance overall. Than the day-to-day, there's more tokenization projects and more experiments being brought on.
Gordon, you talked a lot about like these expansions and more from like expansion of use of stablecoins from more projects coming online. But then you also, you ended with exactly what I wanted to talk about, where more stablecoins are coming online because of the Genius Act and things like that. And I'm wondering how do I understand all these different stablecoins? And the question that I have in my head is like, sort of like as stablecoin landscape evolves, what are the dimensions of innovation that I should look at? How is one stablecoin different from USDC? Like, what are they bringing new to the table? Is it integration with a project, which is maybe like not a, like, I wouldn't say maybe like a true innovation, or are they like, oh, is that the only thing that they can do? What are the other innovations you can see with this evolution?
Yeah, I think so far, we've seen a lot of announcements about new stablecoins, right?
Mm-hmm.
But in reality, if you look at the landscape, it's only a few top stablecoins that still persist. And a lot of announcements, I think they're just announcements. They might not necessarily follow through because, especially for the more non-crypto native enterprises, they don't actually realize the complexity of building a stablecoin. It's very different than, say, a money market fund in which everyone kind of understands and it's easy to manage. There's a whole set of complexity around, for instance, cold wallet storage. How do you ensure that your stablecoin is secure? Well, you need a set of hot wallets and cold wallets, and you need good storage for those, and you need good options for that. Interoperability is also another feature, right? USDC is interoperable across, I think, 24 chains or more now. That is not something easy to build. Essentially, you have to integrate chain by chain to ensure that there is interoperability and ensure that the accountings add up. And also, not to mention, even the fiat side is not that easy to manage. Right? It's one thing to have a stablecoin that you issue, as a one-off, and that might be used as an experiment. It's another thing to have a stablecoin that's available for conversion at any point of the day across multiple jurisdictions into different banking rails, right? That requires a global liquidity network of fiat connectivities, banking connections across the world that are subject to the local rules, that are subject to local issuance requirements at certain points, that could essentially allow direct redemption and direct issuance into that stablecoin. So if you add all those things together, and think about all the complexities that are involved, it's actually quite difficult to build a very large stablecoin with network effect. Now, there are many smaller stablecoins that are floating around, and some might fulfill certain niche, but I think if you think about also the standardization that's been brought up by it's been actually an upgrade in terms of reserve management because of the Genius Act, right? Circle has already been operating at that level of, no maturity transformation, no credit transformation, etc. But that's not automatic for many of the smaller stablecoins that are in other jurisdictions or issued elsewhere. So I think there will be a convergence in terms of the standard and upgrade of the safety and soundness of stablecoin, which is a good thing. But probably the biggest differentiator will be still the liquidity and the network effect and the interoperability and the connectivity. So we'll have to see the different variations of enterprise-driven stablecoins and whether they actually come about, or are they just doing early experimentations and run into difficulty of actually building those. But one thing I do say is the emergence of local stablecoins. I think that's quite interesting, right? Because yes,
What do you mean by local stablecoin?
Local currency stablecoins. So a stablecoin denominated in euro, for instance, we have EURC, but there's also so many other currencies, right? That I think will play a bigger role over time because you're going to have local tokenized assets you have to settle against. There's no way to, well, there is a way, but it's much more complicated to do the FX exchange and the local tokenized asset settlement at the same time, right? So you would end up having quite a bit of local foreign currency, local currency stablecoins denominated in these different currencies. I think that's very healthy to see. And also it's a way to preserve monetary sovereignty of different regions. And you will have a settlement instrument for local tokenized assets.
So what explains the dominance so far of US dollar stablecoins relative to the other ones? And I realize the US dollar is dominant in general, but I don't think to the same extent as it is in the stablecoin market.
Well, I think part of it comes from its background, its usage as a settlement instruments for digital assets, right? It's kind of like how, yes, oil and gas are used and traded everywhere, but it's predominantly traded against the dollar. as a as a commodity, right? So gold as well, right? So a lot of this is just because the market for digital assets has decided to denote everything in terms of dollars. But when it comes to payment use cases, when it comes to trading against tokenized assets in different currencies, for instance, if you want to later on, for instance, if their German bonds are tokenized, right, you have to have euro-based stablecoin to trade against those. So I think it's a matter of time when you have local assets that are already denominated and has a numeric asset as a local currency, that would require local stablecoins. And that would also encourage the growth of local stablecoins.
Maybe this is a good point to transition into ARC, which is probably what a lot of people want to know about. So, as you're talking about interoperability, that's one of the things that come to mind when I think about sort of the success, or not success, maybe dominance of USDC in my mind. And so you guys were already on, as you said, 24 chains. So what, I don't know how to ask this question. I want to know more about ARC, but like maybe the first question is, what role does ARC play now in the future of stablecoins and USDC? I don't know, there's so much to unpack there. Why did you build your own layer one and all these things? But maybe you can you've had to answer this question many times, so you can try to give us the best explanation for this.
Sure.
And we can probe you further.
You can put me for the hard questions. Yeah. ARC is a open layer one that we are building, and the public testnet will come this fall. It is.
When you say open, do you mean public or decentralized?
It is public in the sense that anyone could use it and deploy contracts on it, but it does have a permissioned validator set, and that I think is a feature, not a bug, to have permissioning in the validator set. And we can go into that a bit more, but it is built for stablecoin finance. But more broadly, I think it's built for both everyday usage, but also more importantly for institutional enterprise type of usage, in which you need a
Gordon, I just want to get a clarification. So it sounds like you're saying, okay, so it's a permission chain, but you said anybody can use it. So I guess my question then is like, what is the identity system? So for instance, like, is it a cryptographic system, and so anybody can create an identity, or is there any kind of like onboarding in terms of being able to...
Initially, there's no onboarding. It's when I say permission, it's only the validator set is permissioned, right? So,
but the point is, so like anybody can generate an identity without anybody's permission, and they can send a transaction to the network. It's just whether it gets posted on a block will be a function of the validation process, which there's a trusted set of validators. Is that correct? Or?
Yeah, anyone could create create a wallet on ARC, just like most chains are public. Right? So it is a public chain. It is a public chain, but permission validator set. And it has a couple of key features that I think would really benefit the larger adoption. And it's trying to address this adoption problem, right? Blockchain has been around for more than 10 years. Ethereum has been around for a number of years. But adoption, if you think about in a broader sense, yes, there's a lot of people opting into crypto, opting into digital assets. If you think about the amount of digital assets or tokenized asset, of real world asset that's actually issued on chain, where the amount of enterprise adoption is still relatively low. So we asked ourselves really hard from a first principle and go like, what are the barriers to adoption? Right. One is it's table stake, speed of transactions, how fast, how much processing you could have, which I think now many chains could solve this issue. But another aspect is how do you actually make the user experience as seamless as possible? If people don't want to acquire different type of assets to just pay for gas, can you make that seamless? So ARC will have USDC as gas, and with the optional support of other type of stables and local stables as gas. So that opens up already quite a bit of adoption potential, because it eliminates the need of keeping track of a volatile token on your balance sheet for paying for gas. Right. Other features include sub-second deterministic finality. And I emphasize deterministic settlement finality because I think that is actually needed for more TradFi institutional adoption, to have that sort of guarantee that once a transaction goes through, it is clear and final. There wouldn't be any reversion or rework or possibility of very large chain forks of sort.
But so
And
this
that's
would be
something
related
that
to a trust assumption to the validator set, I assume, right?
this is related to the trust assumption and validator set, but also I think it is related to overall governance and etc. There's a legal definition of settlement finality, which I'm not going to get into, but it's also something that if you read the principles of financial markets infrastructure, guidance from the BIS and the like, right, they clearly state settlement finality being important for transactions, financial markets. So I think while the current ecosystem, while the current chains have done really well in serving the crypto asset type of transactions and serving its needs, I think you do need an upgrade in the infrastructure layer to bring in even more usage, right? We're really looking at the next tens of trillions or hundreds of trillions dollars of tokenized assets, as well as the daily transaction flows of trillions of dollars in cross-border settlements and etc. Right?
Wait,
Opt-in privacy is another
oh,
feature that we announced
wait,
that
Gordon.
will make it part of the ARC.
Before you move on, before you move on from the speed, which Fahad was asking, I was also curious. You said part of getting the speed is from the permission validator set, but then you mentioned something about governance, and I was confused about that.
Yeah, I think settlement finality is the key in which I was mentioning to Fahad, right? Having clear and final settlement in which there are no rework type of risk. That's a necessity from a traditional financial market standpoint. Even if that reorg risk only exists for, I don't know, 15 minutes or so, right? When you make a certain transaction and you say it's done and it has to be done, it can't revert itself.
But you're
So
achieving this because of the permission validator set.
Yes, that is a core feature of
Okay.
permission validator set, and also the consensus engine where we adopted. So we're using Malachite as a consensus engine, which is an implementation of Tendermint, which has this deterministic finality as part of it. There's also, just more generally, right, having a relatively well-known, trusted public company being behind a project also give it a certain amount of trust and guarantees that I think will be really helpful and beneficial for adoption and usage.
But when you said governance, though, it's still not quite clear to me what exactly that means in what you're saying. So, for instance, like, who are the validators? Who chooses them? I mean, I get that there is let's say, an exogenous set of trusted validators at any point in time, but presumably there's some process to decide who deserves to be in that set. Is that correct? And is that the governance process? And could you provide details on that?
Yeah, we'll have more information on exactly how that plays out. But initially, it's a set of validators that ARC and Circle's team will choose. And it's really professional enterprise level type of validators. So unlike a fully permissionless chain in which anyone, whether you're a rogue state or just any individual, could spin up a validator and validate transactions, this is more for you had to go through a process in which when you assure that you have sufficient amount of reliability and history also of operating validators and have understanding of how to do this from a technical angle, but also are compliant to a set of guidelines and rules that we'll establish.
So there are people the regulators can punish if something goes wrong.
I wouldn't put it that strictly, but it's certainly, I think it's not out of question that regulators will ask questions of, well, can North Korea be a validator? And you know the answer there.
But so maybe just one last quick question on this, on the validator stuff. Will the identities of the validators be public? And the reason I'm asking is reputational incentives. Are those also at play? Because of course, reputation can be a very powerful force to get good outcomes, right?
Yeah. So yeah, the identity will be public, right? That's people will know who the validators are, and it's also everything happens on blockchain, right? So there's a lot of transparency still with transactions and with everything that goes on.
Why did Circle, in your opinion, decide to make a L1 to solve these problems instead of a L2?
Yeah, I think that goes back to one of the features that I emphasized, right? Which is this settlement finality guarantee. Right? If you think about today, how much staked native asset there are to secure different chains, right? Most of these chains that are proof of stake relies on the economic security of the value of the asset that are being staked, right? So even Ethereum, I believe it has maybe around $200 billion of stake ETH, which is $200 billion worth of stake ETH, right? Which is a lot. But in the grand context of things of tokenizing trillions of dollars of real world assets, is simply, we think that's not enough for ensuring the network security. It's equivalent to, for instance, if you have a network that relies on $100, can you credibly say that it could secure $20,000 worth of transaction volume or assets, tokenized assets? Probably not. Well, that's about the scale that we're looking at. Right? There are $200 trillion of liquid traditional real world assets that are waiting to be tokenized. There are probably even more, or there are definitely more illiquid assets that needs to be tokenized. So you're looking at, multiple hundreds of trillions of dollars. Proof of stake alone network with permissionless validator set. I think that's going to be a pretty hard battle to argue that it is secure enough for those type of use cases. And in fact, if you look through the latest guidance from BCBS, which is the Basel Committee on Banking Supervision, they actually made this very clear delineation between permission and permissionless validator set, and why that's important for the bank's capital ratio determination. Today, if you hold even stablecoin on a chain that's permissionless, with permissionless validator set, you're subject to essentially 100% of not just 100% capital, but actually dollar for dollar amount of equity capital requirement. Right. So for every dollar worth of stablecoin you hold on a bank balance sheet, you had to hold $1 worth of equities to support that, which is obviously something that deters adoption and makes it costly and expensive for any sort of tokenization to take off. So I do think you need some level of assurance of reliability and assurance that there are no bad actors. Therefore, I think it is about, what can we actually bring in terms of safety and security? How can we expand the pie as well, right? So we're really looking at addressing a different market that hasn't reached the adoption standpoint, and hopefully bring those markets on chain. And through the process, maybe some of them will actually also go to other chains too. But this is about making the pie much bigger rather than competing for the same pie.
So I actually want to pull us back a little bit because you were actually, I think, enumerating at some point the advantages of ARC. And I think, in the light paper, there are three that are laid out and you covered two. So the first one, just as a reminder, that the USDC is the native gas in this case, so stable asset essentially as unit of account. Second one, we've been talking about quite a bit, deterministic settlement finality. But I think you started to talk about privacy. Could you expand on that?
Absolutely. So as you know, blockchains are transparent in nature, but it is both a feature, but also sometimes make it hard for adoption, right? So many of the enterprises we speak to, one of their use cases, they want to make sure that their competitors don't gain an advantage over their transactions, over their payment flow, or even from if you're using blockchain rail to pay your employees, you would want that information to be private. Right? So how do you actually ensure privacy to some extent? Right? So we've done some research on this last year as well, in which we wrote a paper about confidential ERC20 transfers. I think this is a much bigger project of how do we build in modular opt-in privacy. So privacy wouldn't be, it has to be opt-in. The chain itself would be public and open and transparent. But for certain use cases, such as confidential transfers, you could opt in to have private transfers. So the first step is shielding the amount of transfers. So for instance, I pay Fahad a certain amount of dollars or USDC. The amount of value transacted is shielded or encrypted, and our balances could be encrypted. But initially, you could still see I paid Fahad, for instance. Eventually, we'll get to a place where we could also have full privacy. But along the way, the technology, I think, is largely there with not only the different type of encryption methods, but also there with TEs, essentially, right, to make many of the transactions private. But it's also working with the legal and policy side to make sure that it's compliant. So we will have things like viewing keys that could be provided to certain law enforcement if needed. But then there needs to be a full process of determining that there's no legal regulatory overreach either, right? It can't just be any law enforcement could ask for any transaction at any point, but there needs to be a process for that as well.
Gordon, I'm a bit confused at all the different layers privacy can be inserted. So at one level, you seem to be talking about the user, and like their public address. And then another level, you talked at sort of the smart contract with being able to hide how much you're sending. But one question that first came when you started talking about privacy was sort of exposing what your intention is. For example, I think about getting front run on Uniswap when someone sees that I'm going to do a trade and someone decides to front run me. Maybe the confusion is coming from the fact that I don't understand exactly how this is being implemented. I don't know if you can tell us like what are the layers and how it's being achieved.
Yeah. So I think you're thinking about two different types of privacy, right? One is transactional privacy, right? And that is mostly related to the transaction for swaps that have transactions in which, just like in TradFi, you submit an order, you wouldn't want everyone else to see your order and front run you, right? So there are already existing solutions which we're also exploring, right? So encrypted mempool is a typical solution that people go after. Shielding some of the transactions, shielding some of the transactions in mempool. That's not necessarily the only solution, but one that many chains have adopted. The usage of TEs more pervasively in having both the builder, but potentially even the searchers within TE. That's also been explored actively by the research community. Is also something that we are looking into as well. But that's more transaction swap related type of privacy specific to AMMs, I would say. It's very narrow in terms of focus. The broader set of privacy is more about how can you protect users from disclosing their balance every time they make a payment transaction, right? That comes down to, I think that could be more granularly broken down to just having confidentiality that is hiding the balances and the transaction values, but still knowing which party paid whom. versus the full privacy of also anonymity of also not knowing exactly who paid whom, so you don't figure out the relationships. And of course, they have different use cases, right? So, I know, Brad, you're an employee at Uniswap. Of course, you should, people, it doesn't really matter whether people see there's payment flows from Uniswap to Brad. How much it is, that probably should be hidden from the public view. But in other circumstances, there's probably a need for privacy in terms of full privacy of anonymity. That is, imagine a manufacturer having a supply chain, right? They probably want to hide who they're actually working with and who they're ordering from. So you need both protection of the balance and also protection of their addresses, right? So there are innovations in this front that we've seen that are promising. Some involving TEs, others are of varying type, right? Stealth addresses, etc. We haven't fully laid out the roadmap in public yet, but expect that to be coming soon.
So I have a related question, but maybe from a non-technical side of it. The privacy that you're providing, so I think it's clear you're definitely talking about privacy from other people who are reading the public blockchain. But what about from the validators? And part of the reason I'm asking this also is for the regulatory angle of, when regulators want to know particular things, if the validators know it, then okay, there's something that potentially could be given to the regulators. Whereas if nobody actually knows it, then that's a different regulatory situation, right?
Yeah, I think I'm not entirely sure in what circumstance, in
So I guess I'm basically just
validators would
asking,
know.
when you're talking about opt-in privacy here, let's say using the example of Uniswap Labs pays Brad, and we want to conceal the amount of the payment. So I take it that me as just somebody who's reading the public blockchain, I'll have no idea what's being paid. But do the validators know what Brad is being paid?
Possibly. Right? At the end of the day, I think the type of privacy that the legal system and regulators are comfortable with are the ones in which you could still end up auditing it if needed, right? So if somebody should still have a VO key that could be given off. Otherwise, it becomes a pure, tornado cash that it becomes it becomes fully untraceable. I think a lot of illicit activities could happen.
Right.
Not
Okay.
that
Yeah.
well. So
What
Right.
about privacy and censorship? Can ARC prevent North Korea from using their blockchain?
I think we'll be fully compliant to the rules that we need to be compliant with. So,
Sorry, that was
today,
a safe
well,
answer.
today you
I just
have
asked in a dumb way, but yeah.
yeah, you have rules already, right? You have sanction screening, you have sanction lists, right? I know there's Uniswap front end actually has sanction screening that was made very public. When I was there, so I think similarly, you had to have certain amount of guarantees. You had to have certain amount of protection for users to both screen out bad actors are bad for the users, but also bad for the world. So that it's just, I think that's the table stake here for a enterprise ready type of blockchain.
And you can implement this at the level of the validator set because it's a permission validator set, and you can are you saying you can give it a set of addresses that you know or you suspect to be, non-compliant, and you can censor
implement
them?
this at a validator set, but you could also implement this at the protocol level as well, right? I think in a light paper we describe following a sanction list, for instance, being one of the ask of our validators. There needs to be there's probably many cases in which it's much more complex than following a single list. But those are the devils are in the detail in this design.
Okay, got it.
Okay, but so maybe one last question on this point. So if I want to interact with the chain once it's live, I set up my digital wallet, right? I don't need anybody's permission to do that. And then I construct a transaction. I send it into, I guess, whatever the validator nodes are that can post it. Um, is there some due diligence that would be done the first time around to make sure that I'm not an illicit actor? Or so part of what I'm thinking about right now is like, Christian Carlo has talked about this idea of, I think it was activity-based regulation. He used this analogy of sort of, we don't check people before they go on the highway, but if they're acting kind of unusually, then the cops might actually stop them, right? And so I'm kind of curious about in some sense, I'm asking about onboarding, but I don't mean it in the totally mechanical way of like, okay, fine, if your identities are based on some cryptographic system, then it's literally just a math problem. Like I don't need anybody's permission for it. I could create an identity and nobody even knows. But the getting on chain step, because it goes through the validator set, what is the point at which due diligence would be done? And of course, I think as you've suggested, due diligence should be done at some point precisely because regulatory compliance is important, right? But so could you give a flavor of kind of when that due diligence goes in?
Yeah, so that's a trade-off, right? You have very close walled systems. I just saw some private L1 being announced today. That's you had to kind of go through the full KYC to be onboarded and etc. And then on the other side, you have completely open system, right? I think we are an open blockchain, right? Anyone could use and anyone could sign up. It is a public blockchain by a public company, so it has the features of openness. But on top of that, just like the internet is, you have many layers of control. Right? Just like the internet is open for anyone to use, but you had to log in to your Gmail or log into your accounts. You're going to have many levels of controls at the app level that would prevent usage that are kind of not meant for. So yeah, in short, it is a open blockchain.
Okay, Gordon, maybe to wrap up, can you help us understand how Arc will interact with Ethereum and other leading L1s?
Yeah, so that's another feature that we have, which is building interoperability through Circle's cross-chain transfer protocol, as well as a new protocol that we have called Gateway, that are meant to make initially USDC, URC, and our products easily interoperable, but possibly also adding on interoperability options for other stables as well. Right? That is an option of essentially very quickly transferring from one chain to another. So we see that Arc could be a liquidity hub for stablecoin finance because it has very fast interop that it could provide the liquidity to any other chain it's connected to. So that's one way we see it. But in the relationship with Ethereum, right? I have high respect for the team there, and I think they're building something great. And it's the world computer, and it has much broader use case. I would say, there's gaming L2s that are built on top of it. There's a bunch of NFTs that's built on top of it. A bunch of, token trading on top of it. I don't think it's, that it doesn't. I think Arc is kind of trying to get new users, net new use case for broader adoption to be brought on chain. And of course, some of those users will end up going to other chains, especially because the fast interop that we have with CCTV. I see that being like kind of the relationship.
Can you tell us why it was called Arc?
That's his name from one of our very smart engineers, Adrian. He's very creative with names, and Arc, as a geometric line, kind of fits in the narrative of Circle as well as just architecturing something.
Okay, yeah, I could see it. And yeah, before I close, I have this funny dumb thought. I don't know if this ever occurs to you guys, but when you see a new chain, especially as like Arc comes about, I'm like, oh, this is quite cool. How can I get in on this. And, most of the time you buy the token associated with the chain. But in this case, it's kind of dumb to do that because it's
But you can hold
stable.
USDC.
Right. Yeah. So yeah, it's just a funny thought. But yeah, that's it from me. Thank you so much, Gordon, for joining us today. I learned so much about not just about ARK, but the stable coins, and especially from you and Fahad, because I feel like usually we meet, but we don't talk this much about stable coins. And I guess very luckily, there's been a lot more new things to talk about because of the Genius Act. So yeah, thanks a lot, Gordon.
Thank you, Gordon.
Thank you. It's been a pleasure.
We'll see you at the next conference Fahad organizes.
That sounds great.